Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about leveraging the VIX, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
Hey Ernie, I was looking at the last three trading days and noticing that the range for the last 3 days, including today, is nearly the same. There's no coincidences. It's just something that the market's doing, in my opinion, but taking it as a indicator of the range. We're in a low VIX. So we got typically narrow ranges in that.
The range actually, with the level of the VIX right now, actually much greater than it has been earlier in the year when we had a similar level of VIX.
The range compared to the VIX mean?
Yeah, the range right now is relatively big compared to where it was back in the beginning of the year.
With the same VIX levels. Yeah.
So for instance, if I go back to a day chart, and so here's the beginning of the year, and you can see all of these tiny little doji days. That was intense. The VIX was approximately the same as where it is now, maybe within a point or two. But look at these days. The range, there's no comparison. It's definitely bigger in these areas. But as we get higher, it's probably going to, like you said, get reduced. That's one of the reasons why we choose narrower flies, in order to optimize our ability to take advantage of the expected price move.
Kearney, could you explain that a little more about how the narrow fly is better in this situation?
There are a couple of reasons. One is that it will tend to give you earlier wins if it moves towards your fly. The fly itself, just based on its narrowness, will be closer. The gamma risk will be higher. So in other words, it'll look something like this. I'm going to draw one here that is high volatility. And let's say we get in right there. And then another one over here that's low volatility. All right. And we get in right here. So in high volatility, we choose this larger range. So we go a little further out. Let's say further out means 2 strikes. And that's because the expected move is this big, which would get us into this area here. Right. So if you ever notice that this 1 to 9, 1 to 12, whatever, tends to get our butterflies so that the expected move is right about there.
Okay.
In low volatility, we have to go to the narrow fly in order to get our expected move there, because it's not going to go as many times over. It's only going to go to here, maybe. So we have to choose a narrower fly like that, because the expected move is only this big.
Okay. For some reason, I was thinking that in lower volatility, wider would give you an opportunity to have a profit. But what you're talking about makes better sense.
Yeah. So let's look at something else. The other thing is that the P&L, when you get into the trade on a high volatility, is going to look like this, where the P&L on this trade is going to look like this.
Right.
At the same time of day.
Yes. So better opportunity for profit, better profit. And you get closer, like you said. It's the correlation just sometimes doesn't make sense, or it's a learning curve.
Yeah.
I think my expectations for learning are higher than I am.
And when you're doing it, it doesn't all make sense while you're in the trenches doing it day by day. But then after you start looking at it over a long period of time with hundreds of trades, it starts becoming clearer and clearer. But see, I don't know exactly what that range or what that size should be. So I'm saying on these low volatility times or high volatility times, you always work within a range of width. So you could just as easily go a little bit bigger like this, right? And you would trade between these ranges, like between 10 and 20. Same thing on the high volatility time. It could be a little bit bigger. It could be like this. You trade between these ranges. There's somewhere in there's going to be an optimal. You just don't know what it's going to be. But on average, it's better to gravitate towards the higher end if in that particular day, the IV is particularly excited for some reason, like
right.
Economic report or some other geo-macro event or something that's happening, that while the VIX is still low, relative to that low VIX, it's a little higher in that morning. That would compel you, not force you, but compel you to choose the higher end of the range as opposed to the lower end.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.